So what you're looking for is a seller that's really highly motivated. And that motivation is spiking right now because of what we're seeing with coronavirus. From a pure economic perspective, there are unbelievable growth opportunities throughout this situation, fueled by the trillions and trillions of dollars that countries are producing to really tackle this problem. And it's going to fundamentally change everything about our way of life.
I think the most important thing for us is to realize, like, what do I have control over? Those are the things I should be focusing on. And if I don't have control over it, maybe I should just shut the news off because it's possibly not helping me. Right now, I would be holding on to my cash so that I can use it for things that benefit me, that potentially help me grow my business, not like sending it off to government and never seeing it again. It seems like most people want to pull their money out of the market and wait until things correct, but when you pull the money out, you're basically locking in your loss.
Welcome to episode 5 of Crisis Investing 2020. We're going to be starting out with Carl Allen. Carl was a phenomenal interview. This guy's got great experience, and so many people are talking about right now what the opportunities are when you have this type of a downturn in the economy. And again, it's not being opportunistic. The way that we recover from this is by entering the marketplace again. Not everybody getting frozen, but you have to do it intelligently. You have to know what the opportunities are to try to create an economy that's going to start recovering again now. With Carl Allen, he's got a little bit of a different bent because we're talking about people in equities. We talk about, at some points, real estate. We talk about cryptocurrency. We talk about all these things. But what most people aren't talking about is the opportunity to buy private businesses. And I have to tell you, somebody who's been a private business owner for my entire life, and I've owned multiple businesses, I never quite got the context that Carl shares. So you're going to learn something here, and I think you're going to see opportunities that you might not be thinking about right now when you listen to Carl Allen. And then we have John Briggs. I love John because he's a CPA, but his whole thing is about not paying the IRS legally as far as finding ways to save money in taxes, but he has total context about what's going on right now from a CPA's point of view. And then also there's a little bonus where he talks about the varying government, for lack of a better term, bailout stimulus packages. I hear people describing them different ways, but he's got some insights there also. I want you to know, as you probably are very much aware, even at the time of this recording, as we're releasing this right now in the middle of our series, things are still very, very fluid. So when we're talking about some of the stimulus package and those types of things, just realize that the rules and the applications of this are changing on a daily basis. So learn what we have to tell you about there, but further make sure you're looking for anything new that might have come out even after we had that recording. So let's dive into episode 5 right now. So greetings, great to be with you. Very excited to have this particular conversation. You're going to get certainly a view through a new lens here, or a different lens than I think many of the other interviews that we've had. And it comes from, as they like to say, across the pond. We have with us Carl Allen. So Carl, thanks for taking the time to be with us right now.
You're welcome. Thanks for having me.
So let's, if we can, Carl, talk about your background and experience. How did you get to be doing what you do?
Sure. So I'm 49 years of age. I started my business buying career back in 1992. So I worked for an investment bank on Wall Street, and I rotated through different corporate roles via business school. And then in 2008, I left the corporate M&A world, and I started buying and selling businesses effectively for myself. Today, I own a number of businesses on lots of different continents. I own a private equity fund on the East Coast of the US. Again, we own a number of businesses. And my goal is to educate and coach and mentor entrepreneurs all around the world that rather than working for somebody else or starting a brand new business from scratch, want to get into the deal making business. So the acquisition of profitable small businesses wherever they live, the growing and then the selling of those businesses ultimately for legacy and wealth creation.
So this is really interesting because a lot of times when people think about buying businesses or investing in, I guess, private businesses, they only think in terms of probably larger entities like private equity firms and so on that have teams of people that do this kind of M&A work that you're talking about. Yeah. For typical investors, let's say people who have either maybe they own their own business and they've got some resources and they want to grow that way, or let's say that they're professionals or executives that make a good income. They have a certain amount of investment income. Are they the type of people that can enter this market that you talk about?
Absolutely. So we're looking at doing deals generally with businesses with revenues between about $1 and $10 million per year. And really the kind of sweet spots in the 2 to 5, kind of 2 to 6. And that's where the vast majority of businesses actually live. If you look at the 36 million businesses in the United States, 99.9% of them are sub $10 million in revenues. So those are the sorts of businesses that we're targeting. And we work with and we coach people from kind of all walks of life, people that they might be an executive, say at GE, and they want to leave and have their own business and rather start an engineering company. It's actually a lot quicker, faster, and much safer to actually acquire an existing business that somebody else has built and doesn't want to own anymore. We also work with younger entrepreneurs that, again, they've been bitten by that entrepreneurial bug. And, we all know from the market stats, 96% of startups will typically fail within the first 10 years, almost 50%, within the first year alone. So it's a huge hack to get into business by buying an existing company that's got cash flow, it's got employees, it's got management, it's got customers and products and premises and all the things that a business needs. Because when you start a business from scratch, you typically, don't have any of that. And our expertise is we're using a tool called an LBO, which stands for a leveraged buyout. And it's a Wall Street term, which is where I grew up and really learned the skill set many, many years ago. But effectively what we're doing is we're buying small businesses using other people's money. So a lot of people talk about no money down deals. We do those as well. That's where you buy a business, but then you pay for it over time. It's like a lease to buy type model. But you can still buy a business and pay money to the seller at closing, but you don't have to put your own money into that deal. There's lots of different ways to creatively finance that type of acquisition.
So, and I want to get into some of the details of that in a few moments. So given the current crisis that we're in, with the pandemic, and watching literally a startling collapse of the world economies and the market crash and everything else, and it's very fluid, day by day, we're kind of on this roller coaster ride, that's going on. So moment by moment, the sentiments, how the market's feeling, what's going on, the bailouts. I mean, all these things are having, a macroeconomic impact. The question I have is, do you feel that there are special considerations in this environment for the type of thing that you do?
Yeah, so for me, I believe this is the greatest time in the history of the world to be buying companies. And I'll tell you why. What you're seeing right now, the whole market is changing. The whole market is disrupting because of what we're seeing right now with the coronavirus. And there are some industries which I have grave fears for, like the travel industry. So airlines, cruise ships, large-scale hotels, they're going to really struggle through this crisis. And a lot of those big public companies, they're so highly leveraged, they're all set up for kind of hyper growth and shareholder profits that I don't think a lot of those businesses are going to survive. But if you take the small business sector, there are unbelievable opportunities for those businesses. But what's interesting is it's all going to come down to the mindset of the business owner, because the opportunity right now is for traditional businesses to pivot and to go into growth areas which are being driven by coronavirus. So if you look at the global economy, there are two major sectors in business which are booming right now. One is manufacturing, and the second is distribution. So everyone's buying stuff online. The whole manufacturing supply chain for new medical devices, pharmaceutical equipment, increased food purchases, all that stuff is booming those sectors. And if you break down all the supply chains, there are infinite ways that small businesses can kind of get involved. And what's absolutely blown me away in the last few weeks is how some businesses are pivoting. And they're not only surviving what we're going through right now, they're thriving. And I'm not talking about profiteering. I'm not talking about selling hand sanitizer on eBay for $25 a carton. I'm talking about businesses continuing to serve their customers and get involved in some of these big growth markets, and doing it by pivoting their business models. So take the manufacturing supply chain, the trillions of dollars that are being printed and put into the global economy to kind of fuel all the new medical equipment we're going to have to build. We're building new hospitals. We're producing all this new protective equipment, all the new medication that's all being done. I've seen traditional manufacturing businesses that 2 weeks ago were making components for airlines. Now they're making components for medical devices and ventilators. And there's all this innovation that's coming out of universities for lots of quick and new ways to build this medical equipment. And it's going to need the manufacturing sector and the engineering sector to kind of get up off the mat and start building and providing these products. There's trillions of dollars out there to be made for companies that will pivot. But what's going to stop somebody not pivoting? It's not the business, it's the mindset of the owner. And if you look at the demographics, if you look at the United States, for example, according to Forbes, there's 10,000 baby boomers retiring every single day, and 19% of them own a small business. So there's 1,900 businesses every single day coming to market. And today, there's over 2.4 million small businesses for sale, sub $10 million. And when you look at the market stats, only about 1 in 12, 1 in 13 actually sell. And the reason for that is these retiring baby boomers, they've been through the global financial crisis. They've been through all these other big macroeconomic trends and shifts that we've seen in the 10, 20, 30, 40 years since they founded their small business. And a lot of them, this has just become like the straw that's broke the camel's back. They don't want to pivot anymore. They don't want to innovate. They want to sell their business. And in a lot of cases, they will give their businesses away for free because it's going to cost them more money to close them down, liquidate their assets, and then pay off their liabilities. So for entrepreneurs that want to get into business, why would you start a business when you can buy one of these businesses that's been successful? It's got cash flow and all the things you need, but the owner doesn't want to own the business anymore because they just haven't got the mindset. They haven't got the passion to kind of go through and pivot through what we're going to see in the coming months and probably the next couple of years. So the opportunity is huge for people that want to do it.
Validating that, being a startup entrepreneur, I've started many businesses, well over a dozen, and running them as their CEO through those, like the dot-com bubble, 9/11, 2008. And I could tell you, your 2008 was a tough one. I was exhausted, a year or 2 years after. And, my mindset for, if I were looking to make a transaction around then, it would have been a mindset of saying, and it's funny how, a rational business person, the psychology of the situation can absolutely influence what they'd be willing to do at a given point in time. So no doubt if somebody came and if there was a way out and I really decided I just wanted to be out, it would have been a sweet deal for the other party. After 20 years of putting time into that business, which had its maturity and all the infrastructure and things that you're talking about. So I get to see what you're talking about, because starting a business and then, having a business that's gotten to revenue and profit and then scaling it are two very different things, but getting off the launch pad is risky and pretty exhausting.
My analogy, because people ask me all the time, why would you buy a business versus starting a business? And my perfect analogy for this, it's like if you wanted to own a Tesla. So I've just ordered a Tesla. Teslas are pretty new in the UK. I spend half of my time in the States and half my time in the UK, but obviously I'm quarantined in England right now. So I've just ordered a Tesla for the UK. And did I, go out and buy all the components, the wheels, the glass, the battery, the motor, the seats, the iPad in the middle, and then did I assemble them all on my driveway and think, right, how do I build this thing so I can drive it? Or did I go to the dealer, buy one that they've already built, and then finance it using Tesla's money? That's what I did. So that's essentially what we're doing. We're buying a finished product, because 96% of the failures are getting from A to B. We're buying a business beyond kind of point B, a business that's thriving and has survived. And for us, has got the ability to kind of pivot through the situation and really take advantage of some of the unbelievable growth opportunities that, I don't want to sound uncool when I say that. Obviously, this is a global situation, and it's very painful for a lot of people. From a pure economic perspective, there are unbelievable growth opportunities throughout this situation, fueled by the trillions and trillions of dollars that countries are producing to really tackle this problem. And it's going to fundamentally change everything about our way of life.
No doubt that there's, I think it's impossible to predict exactly how things are going to unfold. And I think that things aren't going to be business as usual. It's going to be a new business as usual, probably beyond. So in this circumstance, I guess a couple of questions would be, how do you identify businesses that are for sale? And are there particular types of businesses you'd be looking at right now?
Yeah, so I'll answer the second question first, and I'm going to answer it in two parts. So the first part of answering that question, what type of business should you buy? And really, it kind of comes down to what I call my perfect deal triad. So the perfect business for you is going to be very, very different to the perfect business for me. And kind of let me explain that. So the first point in any business is it's got to be a business that's going to serve you. So if you're a first-time business owner, you want to be buying a business in a sector that you know, a sector that you understand, you've got skills, you've got relationships, you've got the wherewithal to be able to add value to that business. And if you really understand a particular industry and you've got relationships in it, it's a lot easier to build a relationship with a seller and a relationship with financiers for you to be able to get that job done. So back to my GE example, if you've worked in GE for 10 years as a manufacturing manager, you'd go and buy a manufacturing or an engineering business. You wouldn't buy a boutique hotel or a restaurant or, I don't know, an online business, because A, you're not going to understand how that industry works, and B, you're not going to be able to have really meaningful conversations with people around it. The other reason that you would buy a business is if you own a business already and you want to double your revenues pretty much in an afternoon. So let's say you own a software company and you're hustling and grinding and trying to grow that business organically. You can double the size of that business overnight and 5x your profits by buying, say, an IT services company, because then your software company's got products and customers. The services company has got services and customers. You can sell one to the other. That's called cross-selling. And then when you bring those two businesses together, there's a whole ton of cost that you can take out of the combined entity. So it's a 1 + 1 = 3 for the revenues, and it's a 1 + 1 = 5 for the cash flow. And that's how big businesses generate wealth. They're growing by acquisition. Like, look at Cisco. It's bought hundreds and hundreds and hundreds of businesses. IBM, Hewlett Packard, who I used to work for, Microsoft, Google, GE. They grow by acquisition. So that's the first point of the perfect deal. The second point is you want to buy a good business from a highly motivated seller. So I'm not in the game of buying distressed businesses that have run out of cash, or employees are fleeing, there's something wrong with their products, they're under major litigation. People do that. You buy that business for $1, you've then got to jump in, you got to turn it around, you're in crisis mode. I'd rather buy a good business, use other people's money to finance it, then I don't have to worry about the next 3, 6, 12 months in terms of the cash flow. The business is going to run itself. So what you're looking for is a seller that's really highly motivated. And that motivation is spiking right now because of what we're seeing with coronavirus. And people want to sell businesses for lots of different reasons. About 80% of business sellers, they want to sell because they're tired, or they're bored, or they want to retire, or they're ill. They could be dying in some cases, and not just them. It could be a family member like their wife or someone like that. And they've run out of ideas, and they've given up. They just don't want to do this anymore. About 20% of sellers, they're entrepreneurs that just want to cash out and move on to the next thing. And we typically filter those people out. So we're trying to buy a good business for a very, very sensible discounted price, because we're playing on that kind of seller psychology. Then the third point of a perfect deal is all about a business that's it's either got assets or cash flows. It's got a financial profile that will allow us to buy it using external financing. Or if your motivation of the seller is high enough, you can buy the business and just pay for it over time. So let's say you owned a $2 million business in revenues, is making $100,000 in free cash flow. On average, you're buying that for around 2.5 times profit, so $250,000. If you can't retire from that business because you need that cash flow, and you're highly, highly motivated to leave, my first offer to you would be, look, I'll pay you your cash flow every month for the next however many months until I've paid you the full $250,000. And if I don't pay you the money, you can take the business back. You'd be very surprised how many people will take that deal. It's really, really quite high. They don't want to go into work anymore, but they need the cash flow to enjoy their lives. So the fact that they can stay in bed, they can go on vacation, they can play golf, they can do whatever they want to do, but they're still getting the cash that the business used to give them. And when they sell the business, the cash they get from selling is more tax efficient than the income they would have took out the business as the owner. There's a lot of incentives for entrepreneurs and business owners to sell businesses. Governments give them really good tax incentives to do it. So that's a big kind of part of our model. So that's the perfect type of business to buy. It's going to be very, very different for me than it is for you. In terms of finding deals, the biggest mistake that most business buyers make when they go looking for deals is they go to business brokers. Now, there is an advantage going to business brokers because a business broker is in the market of selling businesses. So you know, if it's a business broker deal, the seller's kind of holding their hands up and saying, I want to sell. The problem with business brokers is they will artificially inflate the value of the business. It doesn't work like the real estate market, and business brokers are generally kind of unregulated. So we typically don't go down the business broker route. We'll only look at those types of deals if they've been listed for 9, 12 months, say, where the seller's kind of got pretty distressed and is thinking, you know, I'm never going to sell this thing. Where we find our best deals is what we call off-market deals. And for us, it's all about building networks. So we're doing lots and lots of networking. And the reason for that is if you're looking to sell, if you're one of those sellers that's decided, you know, I need to get out of my business, I just don't want to own this business anymore. Before you go anywhere near a business broker, and most of them don't, you tell 5 people. You tell your spouse or significant other, well, we can't network with those people. And then you talk to your wealth manager, because hopefully you're going to sell your business for some money and then you're going to want to invest it and make it grow. You're going to talk to your CPA, you're going to talk to your attorney, and you're going to talk to your bank or your financier that's supporting the business right now. So what we do, we have a very sophisticated way of networking with those 4 types of people. And that's where we get the vast majority of our deal flow. And then we go through a process of kind of filtering those deals down based on the triad that I just went through. And then those are the businesses that you would ultimately close and then own.
So great insight, incidentally. So this starts to make it tangible that this could definitely be done. When you already talked about buying it out of cash flow as one way to do it, are there other ways that you use other people's money to acquire a business?
Yeah, so outside of cash flow, one opportunity that you have is if you buy a business that's got some assets on its balance sheet. So every business has a balance sheet, and the assets on a balance sheet could be the cash in the business, they could have real estate, they could have plant and equipment, they have accounts receivables, which is the book of unpaid invoices that they've sent to customers, and they could have inventory, and they could also have intellectual property, which generates cash flow streams as they trade the business. All of those assets you can finance. So you can offer those assets up to banks and financiers and other investors, and they will lend the business money to allow you to buy it using all of those assets as collateral. The other way that you can finance deals is to partner with investors. So angel investors would be a very, very good example. In larger deals, people would go to the private equity market or the venture capital market. But in the kind of $1 to $10 million range, most of those kind of institutional investors don't tend to play. So there's a phenomenally booming angel investor market pretty much in all countries. And what's fantastic about partnering with an angel investor is angel investors will typically invest in deals and invest in businesses that are highly related to their own skills and their own experiences. So not only are you getting the investors' money to allow you to buy the business, but you're then partnering with somebody that's probably like me, it's got a lot of gray hair, has been around the block lots and lots of times, and has skills and has experiences and has a network that can be deployed into the business and then leveraged to continue to grow it. So it's like a sparring partner. So that's another way that you can generate financing. And then once you've bought a business, then you can crowdfund. So crowdfunding has become a phenomenal way to raise capital for businesses over the past 5 years. And then crowdfunding gives you, again, a war chest to go out and acquire other businesses to bolt in to the business that you've already got. You can buy competitors. You can vertically integrate inside of your supply chain. So you can buy one of your suppliers or even buy one of your own customers. Or you can go and buy in a complementary market like the software and the services example.
It's interesting because some years ago when we were looking to raise some capital through private equity, what our mantra basically was we're more interested in the brains than in the capital. In other words, obviously we wanted to raise the capital, but it was like, who are the brains coming in and how could they help us grow? I think that's a really important context, to look at. With what's going on right now, there's, I guess your premise is, and tell me if I'm being accurate here, is that there's going to be a lot of businesses that are going to be available, and they're going to be available at urgent terms, meaning people are just ready to go out. And you already mentioned networks, to go to try to, kind of shop these deals. Is there any cold calling aspect? Is like, let's say that I say, okay, hey, I'm in business. I know who my competitors are. And we're probably in a pretty good position. I know some that probably are a bit compromised right now. Maybe I should just reach directly out to them. Or maybe it's even more cold than that, saying they're not even in a business that I'm in, but I start to look for companies that are in an area of my expertise. Yeah. And I kind of could get a sense of their scale. And I just reach out and say, I'm wondering if if you have an interest in selling your business. I mean, is that usually prove fruitful or it's a waste of time?
No, it is. That's a fantastic idea. That's one of our strategies, and we call it the direct approach. So you can do that as a first-time business buyer. Again, you pick a sector. There's a ton of free tools out there that you can use to get lists of businesses with revenues and all those different things, and then you write to them. And the secret to doing this properly is to write to them in a very tailored, very private and confidential, and a very rapport building way. So if you printed 1,000 letters and you sent them to 1,000 businesses and you just said, hey, dear business owner, I'd like to buy your business, give me a call, you might get a 1% response rate or less. If you wrote a letter and you said, dear Jeff or dear John, I felt compelled to write to you because I'm whoever you are, I'm a manager at GE or whatever you are, and I've been working in this industry, but I really feel now is my time to become a business owner. And I've been scouring the market, researching lots of businesses, and I really like your business. And here's why. It could be what you found on press releases. You've looked at their website. You've called them up and gone through their sales funnel. Loads of insights that you can put into that letter. And then what you do is you'll obviously know from the information sources who the business owner is. So you can find them on LinkedIn. You can find them on Facebook. And then you can learn things about them. For example, what's their favorite sports team? Where do they go on vacation? Where did they used to work? And any kind of parallels that you can add into that conversation, you put them in. So if you own a business and I wrote to you, really complimenting you about your business and how much I like it, to the point where you really know that I've done my homework. And then I start talking to you about things that you hold dear, like your family and your sports and whatever you do, and I've got similar interests. When I then follow that up with a phone call, more often than not, you're probably going to want to take that call. And whilst you might not want to sell your business right now, there could be other opportunities. You might want to grow by acquisition, so I could partner with you. You might know 2 other businesses similar to you where you think the seller actually is ready to come out and exit, and you can make those introductions. So those direct approaches are phenomenal because, again, it's an off-market opportunity. It's not publicly listed on a website where everybody can figure out what the business is.
Do you ever, in your model, go in and take either minority positions or maybe even a majority position, but not buy out the whole business, or is it just you want to take the whole thing over?
No, and both of those things that you described. So to the first point, I get involved often in businesses as a minority shareholder, and it's called consulting for equity. So somebody might contact me and say, hey, Carl, I own a software company. I want to double it in size and then sell it in the next 2 to 3 years. Will you come and help me position my business for sale? And I'll give you 20% of the equity. Absolutely, because then not only am I going to get 20% of the cash flow as a member or a shareholder of that business, if it sells for $5 million in 2 or 3 years, and I'll do my best to make that happen, then I'm going to make $1 million in cash when that business sells. On the other side, then in a lot of deals, in fact, the last 10 businesses that I've bought, I didn't buy 100%. I love partnering with people because I'm not an operator. So I'm the deal maker. I work on the businesses I own. I don't work in the businesses I own. That's why I've got businesses in Australia, in Europe, in the United States, because I don't work in any of them. I've got GMs or general managers in those businesses running them for me. And as an incentive, I'm giving them shares or equity in the business to be my partner and run the kind of day-to-day activities. Often somebody will find a deal and they'll bring it to me, and I'll give them 10, 20, even 30% of the deal just for finding it, because finding a deal is obviously the most important thing. You can't buy a business that you haven't found. And then sometimes, whilst the business owner might be kind of a little bit distressed and they don't really feel they've got what it takes to take the business forward, they can sometimes really buy into my vision about what I'm going to do with their business. And sometimes They might just want to come along for the ride, maintain 5, 10, even 20% of the equity, so that when I take owner and I grow it and I sell it in the future, they're going to get like a second bite of the cherry in terms of cash and wealth that they can generate. So to answer your question, I do all of those different things. I'm highly creative when it comes to any deal, because there's always lots of different ways to kind of make it happen.
So one of the things that occurs to me is professionals, maybe doctors, lawyers, accountants, et cetera, that have a practice. Do you find that it works out in a positive way when they look to acquire other, let's say if I'm some kind of a doctor or any of those professionals I mentioned and others, but I find a similar practice to mine, within a certain geography of where I am, and acquire those practices, does that work? Or sometimes is it that, hey, I'm the doctor working in a practice trying to buy another one, spreading me too thin? Or do I have to step back and say, okay, now I'm going to be a CEO and replace myself and then try to do that? How do you see those things unfolding?
Yeah, so just part the medical professions for a second. I'll just talk about lawyers, wealth managers, CPAs, all those different types of people. Those industries always consolidate. Yes, there are people that come and they buy them out, but what you tend to find is those industries tend to kind of merge together. So I don't know if you've ever looked at, architects firms are the same. If you look at all the architectural firms out there, the big ones, and all the CPA firms, KPMG, which is one of the big four, there's over 100 different businesses now wound up in there. It was Pete Marwick, and then it acquired all these other businesses. So they all tend to come together. What's also very interesting in the medical profession is I've got a student in the UK who he was an optician. So he worked in an optical practice, dispensing glasses, doing eye tests and contact lenses. And I coached him. He bought the company that he was working in, and the optician retired. And since then, he's bought over 70 more of these businesses. And that's called a roll-up. So he's just buying all these different businesses, combining them together, and then leveraging a lot of the synergies you get as you start to scale. You only need one CPA in your business. You only need one marketing person. You get better as economies of scale when you're buying products. If you're buying 10,000 of something versus 5, obviously you're going to pay a lot less when you're buying in more volume. When it comes to a lot of the individual medical professions, and I would take doctors and dentists as the two. Typically, they are the business. So physicians in the US, they are the business. So for me, they don't really have a business. They have a job in their own business. And when they decide to sell that business, and most of them fail because there's nothing really to buy, there's no goodwill. Because if that person retires, most of his or her clients are probably going to go somewhere else. So therefore, why would you buy it if that's going to happen? So I would never buy a business where the business owner is the business and it's 100% dependent on them to make it work. I don't buy those businesses.
Yeah, it's interesting because if you look at many small businesses, a lot of them are built on the personality of the founder or the owner, I guess, to some degree. But I guess if it's a direct services business like, doctor or dentist, it's very difficult to depersonalize them and just hire people to put in those places. It's been done, but I guess that's a much tougher challenge than the other scenarios that you talked about.
Yeah. It is.
So now, because I know a lot of people are, doctors, dentists, the people that that we just talked about in varying professions, so is there an opportunity for them, if it is more of a personality-based business, to say, hey, I've got associates now in my practice, so to speak, that can pretty much handle it. Buying another practice like this is not the type of thing. But maybe because I have an understanding of some type of healthcare, I can look for a healthcare company, but it's not a practice, and that's how I can apply my expertise. Am I using the logic correctly?
Absolutely, 100%. So if you're a physician, you could go and buy a medical records company. You could go and buy a supplements company. You can buy a medical devices company. Absolutely. And you can buy those businesses and then partner with somebody who can run those businesses for you so you don't have to run them. So you can still focus on your existing medical practice, but then have all these other streams of income and all these other assets that if you do the deals properly and you put the right people in to run them, that's how you can build future wealth.
Great. So I guess in recapping, right now, and I'm glad you said this earlier because we've been very clear about this. We didn't put this series together to talk about profiteering. Actually, quite the opposite. We believe that paralysis is bad for everybody, but at the same time, people are sort of shell-shocked and paralyzed. And the way that an economy recovers is that people start to enter the marketplace and start to transact again, that you try to get the motor turning or the flywheel spinning again. And that's a win-win for everybody. So it's not about saying, let me take advantage and have somebody lose because I'm going to win. But it's about saying, let's take a step back, really understand what's going on here and see how we can all participate in an economic recovery here and have it be a win-win recovery as compared to people have to lose in the process. So
100%, because at the end of the day, the deals that we do, they always have to be win-win deals. So if you think about the average small business owner in the United States that does not want to pivot, does not want to innovate, and does not want to change their business model to thrive on what's happening, they still have a legacy that they have built that they want to protect. They still have employees that they want to safeguard. They still have a culture in that business and a brand that's really important to them. So if they shut their business down and give up and turn off the lights, everybody loses. The fact that we're coming in, we're going to take that business, we're going to pivot it, and we're going to see the growth with all of the things we talked about before. We're obviously winning because we're buying a business without using our own money, and we're going to generate wealth from that. The seller's winning because their legacy stays protected. The employees win because they're not let go and they've got to go and find another job. The customers win because they're still able to be serviced by the existing business. So everybody wins. So that's what we're looking to do.
Yeah, and I love the thinking about saying, hey, you're creating, because as you said, you're not operating, you're deal making, but making transactions is what creates jobs, gives a job to an operator and other employees, et cetera. And being able to put together a win-win transaction is really the fundamental, to me, the fundamental aspect of any economy is built on that ability. And it's really a great thing. And I appreciate you sharing all this because I am 100% certain that the premise is correct. Right now, there's going to be a lot of small businesses for sale. These are great opportunities. There's some people who are beat up, and it's going to be great for them to come out of that business, and they're going to be able to give favorable terms for doing it. And at the same time, for people who are saying, now's my time to really step up and do more and maybe change courses in my career or expand whatever it is I'm doing as far as my business activities, it's there for you. So, you're the, I've spoken to a lot of people about, the markets and real estate and options trading and all this kind of stuff that they're, giving their points of view about. But in your case, you're the only one talking about, hey, there's a real opportunity here in buying private businesses within that certain range, like you said, maybe the $1 to $10 million range. Deals can be transacted. You don't need to have a lot of capital on hand to do it necessarily. And it can really turn into something very, very nice for the future. So I appreciate you sharing all that.
Yeah, absolutely. And, there's two big opportunities here. One is for employees of larger businesses that they might be furloughed right now or they've lost their jobs and they're dependent on somebody else to feed their family. This is an opportunity to not do that anymore. Buy some businesses that they're going to be as cheap as they're ever going to be in the history of the world. And then you don't have to depend on anybody else for the finances that you need to run your life. And if you own a business already, instead of trying to grow organically, which you can definitely do if you pivot through this crisis, go and buy the businesses and bolt them into what you're doing that are owned by people that do not want to change. Two big opportunities.
Well, that's really terrific, Carl. Thank you very much for spending time during your quarantine in the UK.
Thank you very much indeed. It's been great.
And sharing all this, and then maybe we'll get updates from you sometime in the future also, which would be wonderful to see how things are emerging.
Always a pleasure.
So
thank you very much indeed. Have a great day.
Thank you, and thank you for being here. Greetings, folks. So I have with us now John Briggs, and you might have an idea of what kind of business he's in if you look at his T-shirt. Or maybe not. I think a lot of people feel that way no matter what business they're in. But hashtag IRS sucks. I guess one of the big points that we made in our Money Revealed project, and it's been emphasized by a lot of people, is that when you're paying taxes, or if you're, let's say, overpaying on your taxes, that's the same thing as losing money, or let me do it the reverse way, saving in your tax payments. And we'll talk about saying that these are legal ways to do it, not tax. So we'll call it legal tax avoidance. I guess that's one way to talk about it.
Sure.
But legal tax avoidance is like making more money. It's in the end, it's net income in your pocket. Now, with the whole COVID-19 pandemic and all the gymnastics going on, and incidentally, this is fluid at the time of this recording. Things could be different a couple of days from now as far as the actual bills and legislation and what might be at play. But the bottom line is, certainly they're talking about delaying filing of income tax. Certainly they've been talking about maybe even things surrounding payroll tax and other such considerations. And I think having a tax conversation is an important thing to do. And that's exactly why John Briggs is here. So John, thank you for being here.
Yeah, no, glad to be here. Happy to help. There's a lot of stuff floating around, and some of it has actually happened. Some of it is just maybe they will do this. Others of it is experts giving their opinion, even though they're not actually talking to government officials to get laws passed. And then, of course, you have the people who are trying to profiteer off of all this. So happy to help sort through some of this crap.
Thank you. Well, let's start just briefly just in your background so people know who you are and what you do.
Yeah, so name's John Briggs. We have a tax firm. We really feel like the world works better when business owners and people keep money in their pockets. We don't think the world becomes a better place by paying the taxes and then these entitlement programs that every politician runs on. They just don't, they never track it, because they know if they did, there would be evidence to show that it didn't do any good in the society. So our focus is always, first and foremost, help the taxpayer pay the least amount of taxes possible without being bullied by the IRS. I have 20 team members. We've been around for more than a decade. And anyway, so that's a little bit brief summary for us.
Terrific. So basically, I know that your focus is helping people save money in tax and lower their tax liabilities and strategies for that. So what's your view on what's going on right now, just in general, and then we'll dig into maybe any specific thoughts or actions you think people should take?
I feel like I've developed some sort of level of being bipolar with this whole scenario, because I go in moments where some moments I'm super mad at the government for, I feel like, the way they've shut down the entire country and the world over a slightly more deadly flu and a slightly more contagious flu. And then I go on the other hand, and then I flop back to we don't want people to die over an illness, so let's take precautions. So with everybody else, honestly, I'm just kind of a roller coaster of emotions when I consider what's going on. I think the most important thing for us is to realize, like, what do I have control over? Those are the things I should be focusing on. And if I don't have control over it, maybe I should just shut the news off, because it's possibly not helping me, right? So that's kind of been at least my anchor. Like, let's focus on what we can control, what we know, And then from there, we'll just ride this out the best we can.
So from your point of view relative to taxes, what are, I know that some things are very fluid right now as far as what kind of proposals are being made, but what's being done? What are you thinking about? What are you advising your clients?
Well, the first thing that has happened that this is a truth, they have extended the tax filing and tax payment to July 15th. And so what we're advising clients in regard to that actual law change is, if you think you're getting a refund, don't wait. You should still file as soon as possible, because they will issue that refund to you and you might need that cash for something. If you do owe, don't spend the money if you have it, but keep it just in case. That is one of the main reasons why.
If I can interrupt real quick, if you do owe, there's no penalties, interest, whatever that's going to be calculated. You're basically saying if you file and pay in what's due for last year by the 15th of July, you're good. You don't owe anything more. You don't owe additional penalties.
That's right. That's what, by extending it to July, that's what they've accepted, is that we are not going to charge interest and penalties for not paying until July. Because usually we all have been trained April 15th is the day those penalties start. Right. They've extended that to July. So I just think about that scenario and like, yeah, as a business owner, I mean, some have been hurt more than others. We have lots of clients who are gym owners. We have restaurant owners. We have dentists. I mean, these guys have, like, it sucks for them. I mean, mandated closures or socially responsible closures. They don't know how their revenue is going to respond to this. And in those scenarios, yeah, it's super important if you ended up owing, because 2019 could have been a really great year for you, and now you owe taxes, and 2020 might suck. And you're not going to have taxes for 2020, but that's not due until 2021. So hold on to your cash for as long as possible. Is
there any proposals being discussed relative to saying, hey, if you're adversely impacted in 2020 and you have estimates around that you can actually maybe try to assert those losses against what you might have owed for last year, or there's nothing like that that's being discussed?
There's nothing like that being discussed, because that type of protection is kind of already in the tax code. So just in general, if I had a really great 2019 and 2020 ends up giving me a loss, you can carry that loss back to previous years to recoup some of those taxes. And there's a couple ways to do that. We don't need to get into the nitty-gritty of that, but just in general, if someone's in that scenario, know that your tax professional should be able to navigate that for you.
So let me ask this. So let's lay out a scenario. Let's say that, okay, I had a great 2019. I'm going to owe a pretty good amount of money now on July 15th, what would have been April 15th. However, and I was geared up for July. We're humming along, things, and all of a sudden, boom, the bottom falls out. And it's like, our cash flow went from here to zero almost immediately. We had investments in what we're going to be doing during this quarter of the year, and I can't get my return on that investment, from my business. The revenue's not going to come in. So, okay, I got 3 months sort of extension on having to pay that, but I'm looking down the road saying, it's going to take me well over 3 months to recover from this, and I got a choice to make now. I could take this money that I had and put it into my business to keep my business going, hopefully to recover the second half of the year, or I got to pay the taxes on July 15th. It's going to leave me short on money, and I got to lay a bunch of people off and reorganize. If what I'm hearing is true, though, and I'd say, geez, we're going to have these really known losses, and what if is it a reasonable strategy, or is it too expensive a strategy to say, you know what, I'm not going to pay in July 15th. I'm going to wait till I can get to a point where I can roll forward these losses into the next bill and try to save the cash flow now, but I'm going to get interest and penalties if I do that. What are your thoughts around that style of thinking?
Oh man, I have a couple of thoughts on that. First, I will always vote putting food on my table over paying the government. Always, 100%. So I think when those thoughts come up, we have to first think through like what's worst case scenario and where are the minds of people listening to this going to. There's a possibility some are like, but I don't want to go to jail. That is a legit fear that people have. And I would just say, look, the people who go to jail over tax issues are the people who are committing tax fraud, or if you've ever heard of the actor Wesley Snipes, making outrageous claims and then effectively trying to use those claims to perpetuate fraud at the end of the day. You do
When you
not
say outrageous claims, like I don't know what you mean by outrageous claims, about how the tax code is not true and not proven, or
yeah, like the tax
he
code is
tries to
not a
argue
real law.
that the government doesn't have the lawful power to enforce the
That's
tax
right.
code. Yeah. I would not play that game, but go ahead.
Whether if you look at the actual law and you read it and you're like, yeah, I guess based on what I'm reading here, they don't. In real life, they've been given the power to do that, so you kind of have to go off of that.
And they have the guns.
Yeah, I mean, I've heard people use stupid claims where they're saying, well, the government assigns a number to you, so you're a straw entity, you don't really exist, therefore you can get a refund for. Don't fall for that crap.
We don't need to waste time there. Go ahead.
Yeah. So just know that just because you can't pay your taxes doesn't make you a criminal. You're not going to go to jail. The risk you run is penalties and interest. And I'm kind of willing to bet, I mean, not like a 90% bet, but there's a better outcome. I feel like if you were in this scenario, they might end up removing your penalties if you write them a letter explaining why you chose to pay after July 15th. Mm-hmm. For the sole reason of, yeah, it crushed my business, I laid off people, and I had to use the cash to put food on the table. If you communicate with them, the IRS being them, most of the time they will work with you, at least to the point where they're not going to seize all your assets and things like that. So yeah, I mean, to your scenario that you laid out, if it's unknown, I'm holding on to my cash until I do know. And if that means I file in July and the first thing I do on July 16th is call the IRS and ask to be put on an installment agreement where I'm, hey, you know what? It's a little uncertain for me. I would like to pay this over the next 72 months. Mm-hmm. That's also not a bad idea. If you're in that scenario, because there are people who are going to be in this scenario, it's totally unknown. I mean, I have some dear friends that are speakers. I mean, that's his livelihood. He doesn't have recurring revenue. Mm-hmm. Canceled 7 months out, all of his events canceled. Mm-hmm. Anyway, so yeah, don't pay the government because you think you're going to go to jail. Pay the government if you're confident you're going to have the cash flow to support your life and keep your business doors open. But if you're not sure, go the route of setting up an installment agreement or just waiting. It typically takes the IRS 3 to 4 months to get you first to send you a letter saying, we show that you owe us money and we don't have your money yet. Even at that point, 3 to 4 months down the road, you could then write a letter saying, yes, I'd like to get on an installment agreement. And those installment agreements, if you set it up under 72 months, like you just divide the amount you owe by 72 months, it's all on the form itself that you send. They accept it without, I mean, I've seen it accepted about 99% of the time without any sort of back and forth. They just accept it.
Yeah, I think there's kind of an automatic under a certain amount. I don't know what the rules are, but and I think, like you said, they're probably going to be a lot more lenient during. They're showing at least they're looking to be very lenient. They don't want businesses going under. They want businesses to stay out. I know that they're putting some loan programs together, I think, for small businesses, and a big part of the infusion they want to put into the economy is to protect those businesses. So that's interesting. Anything else that you're seeing that's either being talked about as a possibility that we should be thinking about, or are there any myths currently that are being perpetrated where people are saying, hey, this is what's new, and it's really not true from a tax perspective?
Yeah, so definitely two thoughts immediately. First of all, some people especially business owners, might be in the habit of making their quarterly estimated payments. And I know I've gotten this question a lot, at least in the last 7 days, from our clients. So it might be on the minds of others. The quarterly estimated payments, the sole purpose of that is, in my mind as the tax professional, not from the IRS's standpoint, from my perspective, is to help you avoid the underpayment penalty, which is basically a penalty the IRS charges you if they don't feel like you paid in enough money during the year based on your income tax. It's a penalty that, because it can be so easily avoided, I don't feel like burning that money if I don't have to. It's always based on last year's tax return. So if I owed $15,000 last year in taxes, the IRS would expect me to make, whatever 40 some odd $1,000 payments over each quarter, so that by the end of the year, over 4 payments, I would have paid in $15,000. I've avoided the underpayment penalty if I do that. Now, what also happens though is you can go off of what your current tax liability is. It's just because that's unknown, a lot of people aren't sure. Well, in this scenario where the coronavirus has kind of forced the world into what seems to be a recession, or at least what some are predicting will end up being a recession, certainly a downturn in the market, you possibly aren't going to have any tax liability. And if you do, it's going to be significantly less than last year. So again, I would recommend not making the estimated payments right now. If you have the cash and don't need it, for sure, set it aside. We're big fans of having a bank account called tax, and you set aside money in there throughout the year, like twice a month throughout the year type of scenario. We're big fans of that. But if I don't have to actually send it off, which I don't, I'm going to keep it in there for now. As long as I pay in by January 15th of the following year, I can avoid the underpayment penalty. So that gives me a whole lot of time right now to see how things fall. All the unknowns, there might be a big chunk of those that get answered over this course of time. So again, right now, I would be holding on to my cash so that I can use it for things that benefit me, that potentially help me grow my business, not like sending it off to government and never seeing it again.
So maybe as a kind of a summary, at least thus far, the only executed change is the filing date moving from April to July 15th, right? Is there any other actual changes that are a direct response to the pandemic?
Yes. And actually, as of right now, from my understanding, they are in the process of letting us know what's officially in the bill. As of yesterday, they agreed, Congress has agreed on a $2 trillion stimulus package. The stock market obviously responded positively to that news, but we don't know everything that's in it yet. They haven't published, at least I haven't read published information on that yet. So by the end of the day, we might have some more information. But what has passed, and I don't remember the exact name of the law, it's like Coronavirus Emergency Family Medical Act, something like that. If you have employees who actually have the coronavirus or have to be at home to care for someone who has the coronavirus, the government will reimburse, like you don't have to fire them, you can still pay their wage, and the government is going to refund 100% of that wage up to 2 weeks as of right now, and they'll reimburse you the Social Security tax. If you have an employee who has a child who has to be at home, they will reimburse 65% of that person's wage. And they all have weird, like up to $500 a day for the coronavirus one and up to $250 a day for something like that. But so you don't have to lay those people off. For the employee who has a child at home who then has to be at home to care for them, it's like 3 weeks in this instead of 2 weeks. So those have actually happened. What they haven't been clear on, well, how do I go about getting that money reimbursed? As of right now, based on what I've read, it looks like that gets handled when you file your payroll tax returns, which are quarterly. If you can't afford that cash flow, like if you can't spot them that, you can go to the IRS and request like an advance on it. Those are the things that I I'm aware of that have actually passed. Now, when you asked about myths, I think there's lots of myths out there where business owners think that this applies to them regardless of the scenario, and the government's going to reimburse all their wages that they pay to employees or their own wages if they're not able to take it. I have not seen any of that literature. I don't know where that exists. No one's been able to point me to credible sources on that. As of right now, it's just those three categories on the reimbursement of wages. Actual coronavirus, have to care for a coronavirus, or kids are at home.
Any other advice you're giving your clients who are either business owners or wealthy and have lost a bunch of money in the market in these past weeks, or both, that you think would be worth revealing?
Honestly, not a ton. Just in general, man, you're going to want to talk to your financial advisor, because in this time of scenario, I get the rational, or maybe it's irrational, I don't know. It seems like most people want to pull their money out of the market and wait till things correct. But when you pull the money out, you're basically locking in your loss, where, the stock market rebounded 1,000 points just with the news that there's a $2 trillion stimulus package coming. So, man, I don't know. I feel like that's more of an investment advisor's wheelhouse. We're more on, let's have people save on taxes so they have the money available to invest. Other than that, we try not to give too many things.
But actually this is a tax question that I think is important. So if I'm weighing all this out right now, and let's say I had a bunch of money in the market and the market's way down, and I sold, I am locking in those losses, right?
You are locking in those losses. So those would be taxable capital losses. Here's the problem with capital losses. The government just will not, there's not a scenario where they're just like, hey, we're going to let you benefit 100% from this bad stuff. It's like kick a man while he's down. So if you have capital losses, you are allowed to take up to $3,000 of those a year, unless you have capital gains to offset it. So if I have a bunch of money, which a lot of wealthy people do, playing in the stock market, and this thing just happened in the last 2 weeks, and now my portfolio is down 50%, there could be hundreds of thousands of dollars of capital losses that they have. The only benefit they can get from that is if they also have a couple $100,000 of gains that they'd also want to close out on. So
they carry forward for another year, those losses?
The losses carry forward, but it's still $3,000 a year. I remember that's it. So I had a client one time, and this is like 6 years ago.
I just want to be clear on this. So you're saying that if I get the gains in the market, I have to pay tax on those in the year. But if I have losses, I can only take $3,000 a year?
Unless you have gains that you're offsetting against it.
And do the gains carry forward also?
No, because you pay the tax on the gains in the year that you have them.
Right.
But let's lay out some scenarios.
Okay.
So let's say right now I have a $100,000 loss, and I sell them all. So now I have an actual capital loss of $100,000. If I do nothing else, I can take $3,000 for the next
33 years?
33 years. Yeah. Not optimal. So that's one scenario, and that's how that would play out. So let's say I have $100,000 of losses. I would want to purposely look at my portfolio and see, well, do I have any positions that are a gain? I want to close those out now. So if I have those positions, I close those out, and those equal $100,000 of gain, the two would offset against each other. So I would have zero capital gains on my tax return. And now I have a higher basis in that closed position going forward if I wanted to rebuy it after 30 days.
You just said something. So I shouldn't rebuy for 30 days. Otherwise, it's not considered a loss at that point.
Yeah, it's called the wash rules. Whatever, it's the government. They created it Yeah, so you'd want to wait at least 30 days to repurchase that position. So that's how those offset each other, but a lot of people don't think about that. Now that's a good tax strategy at the end of the year. If you're looking at your portfolio and you're like, man, I have some losses, find the gains as well, because you're not getting the real benefit of those losses unless you have the gains to offset it.
And those gains are perspective that you can't go backwards, I guess, is what you're saying. Because a lot of people had a lot of gains. They paid all the taxes on the gains, but now that they have the losses, they can't take the advantage. So that's like really sort of unbalanced, isn't it? I mean, as far as saying, you got to pay the gains when they occur, but when you lose, you can't take the loss.
That's right.
That's like the government locking in their gains and not being.
See this?
Hence the shirt.
Yeah.
Wow, that's really interesting. So do you only pay on the gains when you sell your positions? Like, in other words, if you're holding a position but you don't sell the position, then you're not paying tax until you actually close out the position, correct?
That's right. Yeah. So the tax people call this unrealized gains versus realized gains. So it's like, on paper I have the gain, but I don't realize it until I actually close it. And so anything that's on paper that's in your holding account, all that movement stuff, it's just movement. It's not real life until you actually close out.
Okay. And therefore, whenever you do, it's a capital gains, not regular income.
That's right, which is favorable. Capital gains rates are better as of right now. If you're above $420,000 of adjusted gross income, you pay 20% capital gains. If you're lower than that, it's 15%.
And same true on the losses as far as, the loss, I guess, is just the total loss to reduce your total tax burden, right?
The loss would offset your total,
Yeah.
just whatever your taxable income is.
All right, because I think that's what a lot of people are thinking about right now is saying, hey, I've got losses in the market. How can I turn this into a positive maybe somehow? But you're saying that in the same year, if you don't have a capital gain to offset that loss, you're getting $3,000. And, that's because there's a lot of people, I mean, I literally, talked to a friend not long ago and he was a few $1 million down, just in the past week. And and it's like, but he probably has other income, but I don't know if it's going to be this year. It was maybe, so he might be kind of screwed in that scenario as far as the tax advantage. It just really depends.
Yeah, and it really depends on how the year ends, but I was telling you, about 6 years ago, I had a client and same scenario, he came to me and we look at their prior year tax returns. I'm like, you have a $700,000 capital loss? I'm like, what happened here? And he told me the story. I'm like, great. So when you're 482, you'll have benefited from all of this loss. No one ever explained it to him, but he has a portfolio of stuff. And so we just looked at it and it's like, look, you can exit out of this real estate property here if it's not cash flowing the way you want, and all that gain you were worried about, we can offset it against the $700,000 that we're able to carry forward for some years. And so for your client, he ought to sit down with his tax professional and look at his portfolio of things. And if it were me, I would personally, this isn't maybe right for everybody, but I would be trying to exit out of gain positions so that I can offset that in the current year, and then just pick up the position again in 30 days. I mean, if it's your real estate income, if like you have properties, those gains will offset the stock losses.
Mm-hmm.
So if you have properties that you own that, you're considering selling right now, maybe before the entire recession hits, or for whatever reason you feel like is appropriate to sell, those could offset your stock losses as well. So instead of having to worry about, do I 1031 exchange this property to a different one and all the real estate rules, you already have the stock loss.
Yeah, and so I think from a tax perspective, and of course there's varying scales. Some people, they just had retirement accounts in the market, and they're licking wounds. And then there's people who maybe have generated wealth and have real estate, they have stocks, they have precious metals, they have kind of a diversified portfolio of assets that have comprised their scenario. And the thing, I guess, the conclusion I'm drawing from what you're saying is, hey, If you're in that position where you have assets that you've made money on over time that you've been holding, so you don't have a realized gain there, and then you've had a really bad loss in the market as the market turned down. If you didn't already sell, you could sell, lock in those losses, put it against gains in the year. Because like you said, if I had a piece of real estate and I was like, I think this is a marketable piece of real estate right now, would transact this year, and I've made a lot of money on it, but the tax burden was going to be too high for me to liquidate. Now I can liquidate, put against these other losses, and find myself kind of in a better position. So there's ways to navigate, I guess, this whole thing, utilizing tax scenarios to be able to have maybe an adverse impact from this severe and sudden economic downturn, that I can mitigate some of that adverse impact, or maybe even a lot of it, depending on what I got going on. Is that basically the summary?
Yep, great summary.
Yeah. So anyway, anything else that you think is worth sharing before we tie up?
No, but if you ask me to borrow, maybe once this law gets published, maybe.
Yeah, well, we'll probably be doing updates. I mean, as things are occurring, I appreciate that, and I know that like always, as for your life, taxes are not sexy. It's just a lot of rules, a lot of code, but in the end, because people don't really pay much attention to taxes, there's an ignorance tax, as my friend Garrett Gunderson says. There's an ignorance tax that you pay for not knowing these things, and really focusing here. I see a lot of people, again, like friends of mine, like I said, my one friend lost millions of dollars just in the last week, who have multiple assets, that when they focus on what's going down, kind of the panic of what's going on, and if they take a step back, look at the big picture, you could probably mitigate a lot of this if you're in the right position to do so. So
yeah, I guess maybe one final thought. You really want to check with your state. The states right now are like Utah just came out with their recovery plan, and it's 3 phases. Your state probably has something like that, or at least they're working on it. Banks in your area are probably looking at how do we lend. I have a relative who works for a bank in California, and she was just asked by their bank, like, run the calculations, what will our income or cash reserves look like if we allow people to forego next month's payments on all their loans? So like banks are, like, people are trying to help. Like, that's one of the good things about this, is people are good people. And I think we're seeing that in general, most humans care about other humans. But one of the things that I read, which is why I'm like, you should look at what your state's going on. It sounds like, and I don't know all the details yet, but it's intriguing enough, I'm going to look into it. The state is saying once they're in a certain phase of their recovery, whether it's phase 2 or 3, they're going to be giving out loans that may be forgivable if you're using the loan that you receive for certain types of qualified expenses. So like, for example, I'm a part owner in a gym, and we closed our doors last Monday. And so right now, our members are supporting us, but depending on how long this goes, our virtual workouts might not keep them engaged. And there's other businesses that might not be able to keep their members, like their clients, engaged. Well, if that happens, I need to go to the landlord and just be like, dude, I can't pay you. Now, I read the rent might be something that's a forgivable loan. So if that means in phase 3 or whatever phase the state's saying I can apply for a loan, and then if I use it to pay the landlord back, I don't actually have to pay the loan back. I mean, you want to look into those things, because and especially SBA disaster recovery, bank loans, the interest rates. Look, I hope this doesn't make me sound like a profiteer, because I don't believe in that. I think if you're taking advantage of people, that's wrong. But I don't think anyone should feel bad about selling their services during this time. Like for us, we have a cash flow management system that we sell, and it's more important now more than ever for business owners to look at things like that. Like, how do I cut back expenses? What was a productive expense 2 weeks ago might not be anymore, because now everything's virtual, at least for the short time. I'm looking at these SBA loans and I'm like, holy cow, if I could get $1 million loan, I can actually refinance a couple other loans that I have that are higher interest rates. That's just a smart move. Like, I think people need to be looking at opportunities like that, because at the end of the day, cash needs to keep cycling in our economy if we're going to minimize the damage of whatever this is doing.
And I think that's what people need to understand, like, because I think politicians don't get this. You can't stop the engine and keep everybody where they are. And that's well, just everybody freeze. It's like, no, it doesn't work that way. You have to have some movement, and the engine has to be turning in order for things to work. And if you just freeze the engine, it's not like, oh, you go back to normal, a month later, the economy has been killed. So it's really interesting. And I have seen similar things that, nothing conclusive, but, potential proposals around loans that turn into grants, if they're used in the right way, and then you show that you actually used the money to save your business, and then if it kept you going, we'll forgive the rest of the loan. So it's very, very interesting what they're proposing. I don't know what it's going to mean to print a bunch of money and put it into. I realize it's a crisis situation, but there's a lot of unpredictability around it too. So John, I really appreciate you taking some time to at least look at this from the tax perspective and what implications lie there relative to the current crisis that's going on from an economic perspective. And I really find your insights to be very valuable. So thank you.
Yeah, thank you. This was a pleasure.
Well, here we are, back with John Briggs. This situation is so fluid. We've been working now for about a couple of weeks, at least day and night, interviewing people, getting as much content as we can. And as new things are emerging, especially from this whole, I know they're not calling it a stimulus package. What are they calling it, John? These things.
Well, the latest one is still called the CARES Act, even though they kind of changed the name of it with the law that was finalized. But most people are referring to it as the CARES Act loans.
Okay, so they have these phases of government loan programs that are directed toward helping a recovery during this significant economic downturn relative to the coronavirus. So, we had seen some of this come out. Then we started to see that John Briggs was holding these Facebook Lives for his friends, clients, well, not friends, but clients and people out there who are interested. And we said, we kind of talked about this in the abstract to a degree, but a lot of people have specific questions about it, at least what's known to date, which right now is April 1st. So we thought that we'd beg him to come back and ask him what are the most frequently asked questions that are happening and how are you answering them. So we decided we'll put this in as a bonus for the people who need to know about this stuff. We've got a great expert who's been answering a lot of questions around this. So John, maybe set it up a little bit as far as what you're seeing as what's being put out from the government. And what are the most frequently asked questions you're getting?
Okay, so let me start with the basics so that we have somewhere to go off of. As of 2 weeks ago, there have been these things called economic injury disaster loans. We're calling those EIDLs just because it's a mouthful. Those are the ones that are 3.75% interest rate, up to $2 million, potentially up to 30 years term, and they can be used for anything with your business if your business has suffered some sort of economic decline due to COVID-19. You apply for the EIDLs directly through the SBA's website. So that's that loan. Then you have these new loans that were officially law as of last Friday, and they're called Paycheck Protection Program loans. I've been calling them triple P loans, mainly because when I started, I said PPP, and I got sick of saying PPP. It sounded like I was talking to one of my, my 6-year-old. So triple P loans are the ones that most people are having questions about now, because now that both exist, there's this thing like, which one should I get and whatever. So the basics with the triple P loans. These loans have the potential to be 100% forgiven And when they are forgiven, they will not be counted as taxable income to you. You have to use them on specific expenses. The big one being payroll, and we'll talk about how they define that. Mortgage interest, rent on lease agreements, and utilities are the main ones. There is another one that honestly, off the top of my head, I don't remember just because I don't feel like it applies to many people. But so the most you can get on that loan is 2.5 times your average payroll cost. And again, when I get into the frequently asked questions, I'll kind of define what some of those mean. But so you take your average monthly payroll cost, times it by 2.5, that's the most they're going to give you on that loan. As soon as I get the loan, I have an 8-week period to use the loan on things that will allow the amount to be forgiven. As of last night, the SBA came out with their sample application, and they've helped us clarify a few things. They are saying in order for it to be forgiven, no more than 25% of the loan can be used on the non-payroll expenses that they list. If more than 25% is used, then the full amount will not be forgiven. If you use it completely for payroll, you have whatever you use that for on the 8-week period, it will be forgiven. Now, that's what they're saying. I'm hopeful that they will honor that, but I also have a feeling that when it comes to proving that you actually used it for payroll expenses, they are going to ask for a significant amount of evidence, is my general feeling on that. But again, if I can prove it, it will be forgiven. That means I do not have to pay it back. And so those are the basics of what we're talking about.
This also covers contractors too, right? That are a regular part of your business, not just W-2 employees.
That's right. The law specifically says independent contractors, payments to self-employed people or independent contractors are also covered. It also says that as an independent contractor or self-employed person, you could apply yourself for one of these loans. It is unclear how they're going to monitor all that. I would just say, just to be fair I'm a big fan of being aggressive, but in this case, just to be fair, if you know that the person that's paying you as the independent contractor got one of these loans to pay you, don't go and get your other loan and try to double dip. All right, so with the PPP loans, a typical question we get is, well, what is average monthly payroll cost? What does that mean? Because generally the tax code, when it's talked about payroll, it's only referred to W-2 people. The law is saying wages, commissions, and other similar compensation, but again, not just to W-2 people, but also to self-employed or independent contractors. So you would look at all of those expenses you have to figure out your average monthly payroll. They have given us, as of last night, 3 time frames that you would look at for the calculation. If you were in business all of last year, you're going to look at all of 2019's expenses. You're going to divide that by 12. That's your average monthly payroll cost. If you are a seasonal business, they give you a window. I feel like it's like somewhere like February to August or something like that. They'll let you use a 6-month period to effectively get you the highest number possible. It really is what they're doing. And you divide that by the 6 months. Or if you just started this year, you would use your payroll expenses so far this year to figure out the average monthly payroll. Terms on the PPP loans for the amount that's not forgiven, this is the real number. You're going to be blown away. 0.5% interest rate. 0.5% is the interest rate on the amount that's not forgiven. It'll be a 2-year term. But I mean, those terms just came out last night. It's crazy. So even if you end up not getting it 100% forgiven, that is the best loan that I've ever seen in my entire life. So not a bad deal.
Not a bad deal at all. Any thought or any communications on what they think the turnaround time is from the time you submit to the time you actually get the money?
No. I do know they said they will be processing applications from banks as soon as April 3rd, which is in 2 days. So banks I know are scrounging to get their application stuff in order so they can actually, get those sent off.
Mhm.
I don't know. I mean, they're supposed to give it priority. I'm imagining they will, but I don't know.
Yeah, I think there's certain business sectors they might prioritize, that they feel there's more desperation, what have you. So very interesting. And then on the, I guess the other loans that you're talking about that are they also going to be granted? The other ones, I think they go up to $2 million that you described. Are they also looking at saying, hey, if there's some idea that if you are paying on them consistently for some period of time, they might forgive the loan?
I have not seen anything on those. So those are the EIDLs. What they have said is if I apply for that, which I actually did, which is great, and I'll talk about the application process. At the end of the application, you can check a box and say, I would like $10,000 advanced to me. If you get that advance and they deny your application, that $10,000 became a grant, meaning you do not have to pay it back. And from what I see, you can use it for whatever you want, because at that point, they've kind of closed the book on you. If you get approved, the $10,000 is in advance, so it would reduce, like whatever the total amount they approve you for, they would send you $10,000 less than that. My initial thought when I heard about these loans was, holy cow, 3.5% or 3.75%. I'm going to refinance all my other debt into this. They specifically have listed that as a non-approved use of funds. So effectively, you can only use the EIDL loans for business expenses, ongoing business expenses. But again,
outside of payroll and so on, or can you include payroll?
You can use it for payroll. You can still use it for payroll. But you
And
can
so
also
can you
use
apply
it
for both? Like if I'm going to use the EIDL, remind me what that stands for again?
Yeah, economic injury disaster loan.
Okay. And so if I were to say I apply for that and in part I'm using it for payroll, can I also do the PPP loan and ask for both?
So the law specifically says you are not allowed to have another duplicative loan or application for the same amount. So, but what that does mean is I feel like what they're saying is I could get the EIDL for other business expenses, like maybe my vendors who aren't independent contractors, who are corporations and businesses. I could use that for advertising, those types of things. If I got the PPP loan, I'd use it for payroll. Therefore, I don't have a duplicative purpose. But I have not seen clear guidance. I imagine they are going to give that to us at some point, because I know that's a question on a lot of people's minds.
And you can't submit an EIDL yet, right? They don't have those applications ready yet, or they do?
So the EIDLs, yes.
Okay.
And if anyone listening to this tried to apply the first week they existed, the application was horrendous. As of this week, they've changed the link and updated it. And now, in my opinion, even people who hate numbers and don't feel confident in these things, you can get through it in a half hour.
Wow.
I mean, it's really fast. It took me like 10 minutes.
Wow.
It's a very simple process. They do not ask for a lot of information. And that's where you request a $10,000 advance anyways. Why not ask for it?
Nice. What other questions are you getting relative to this? It seems like, okay, applications are there. The applications actually have been improved. You could submit. You can't have, there's certain terms that you can't conflict with that you enumerated. Anything else that we need to know about these things?
Yeah, so as of today, April 1st, there is confusion that like the PPP loans are the same things as the EIDLs or whatever. Like I have not seen a real application yet for the PPP loans. Even like I'm on quite a few banks lists so that I'm aware of when they are processing these things. And right now, everybody who has an application, they're just holding places. And at some point, you're going to have to get on the phone with an underwriter or with a lender. So some of the questions that come up are like, well, I mean, if I don't have to prove I need the loan, then I should just apply for it. Because some businesses haven't been affected by this. I know I feel like every business could probably argue it, but I mean, if you haven't lost any customers yet, have you really been affected? But anyways, at some point you will have to explain why you need the loan. I think these simple applications are just like a way for them to filter out. I'm sure they'll be able to deny people just based on the simple application and save themselves some time of more in-depth underwriting. Yeah, so keep that in mind. As of the filming of this April 1st, there's no true application. But once there is, maybe by the time people get the recording, we are recommending start with a bank that you have a relationship with already. They likely are offering these. And that's where you would start with the PPP loans.
So I guess a use of the loan can be for loan servicing. Let's say, for example, my business is real estate, and I hold a bunch of mortgages on a bunch of rental properties, and my renters can't pay because of the downturn. So I could probably apply for this loan so I can service other loans. I guess that would be an appropriate use for an example, right?
Yep. And if you're using the PPP loan for that, my guess is 25%. If you used 100% of the PPP loan to cover mortgage interest, basically, 25% of that loan is going to be forgiven because that's what they're currently saying. You would end up having to pay back the other 75%, but again, at a 0.5 interest rate over 2 years.
But it sounds like the emergency relief loan is probably more geared toward that type of a scenario, right?
Yeah, the EIDL definitely sounds like it'd be more geared towards that. I mean, plus with the EIDL, you're going to be able to apply for a much larger amount of a loan, where the PPP loan is limited to 3 times your payroll cost. And so, end of the scenario you described, the only payroll cost might be, and this isn't even clear yet, if it's a distribution to you as, the owner of the properties.
Yeah.
And most.
Which is, to be clear, that's not, I mean, yes, I have a couple rental properties, but that's not my scenario. We're applying through our businesses, for payroll and for, relief from, business interruption, basically.
Yeah, but there's probably lots of people who have multiple properties. I mean, this is definitely something they should be considering, for sure.
No, and that's why I asked the question, because I know that a lot of our viewers are probably in exactly that particular circumstance. So that's why I kind of explored that a little bit. So because it's very interesting. I think it's, as you said, like, for example, if you're a restaurant right now, you definitely had business interruption. You got, so you can you maybe keep your employees by the payroll side, but also you've got no revenue. You probably had inventory of food, that's no good anymore, and all kinds of other injuries because the business is forcibly shut down. I think there's some businesses that are almost like they're automatic, and then probably businesses like mine, and I have a few businesses, but it's they'd have to actually show some more detail to be able to demonstrate. Now, we invested in certain projects, we're ready to release those projects, we couldn't, we're delayed, so we have this gap of time where we have no revenue coming in. So there's varying scenarios depending on the business, and it's kind of interesting how because the volume is going to be overwhelming as far as the application. Everybody I know is applying, so
everybody.
It means the volume is overwhelming, and their ability to vet it, unless they're going to take years to try to distribute the money, I don't think they can do much vetting. So it's going to be a really interesting thing to see how this unfolds.
Well, and if you think about it, they're protecting themselves, right? Because right now, the PPP loans, there's no personal guarantee, there's no collateral. Like, it should be really streamlined because based on the requirements, they don't need a lot of information from us. They're basically putting it in the hands of us to be basically honest with the reasons we need the loans. If we get to the end of this period, that's in 8 weeks from getting the loan, that's when the real kicker is like, okay, prove to me now that you use it on these things. And if you didn't, well, then you're going to pay us the money back. I mean, so they're not out anything. And while the SBA isn't charging any fees, I've been telling my clients this, like, look, I want to help you stay in business, but I can't turn my business into a charity and lose my business helping you stay in business. So like those who are asking us to help them with the applications, like, yeah, I got to charge you for this work. I can't do it for free. I got to be around, right? It's no different with the bank. The bank is, they're going to have to charge you a fee to underwrite the loan. I'm sure it's going to be reasonable because there's going to be a lot of public pushback if it's not. But, they're making money to cover their work on the front end. If you don't have a viable reason for why it should be forgiven, you're going to have to pay it back at the back end. They're protected.
Well, maybe we live in interesting times, but this is really kind of wild stuff unfolding day by day. It really is. We've never seen the likes of this before, and hopefully we'll never have to see it again. So anything else, John, that you think we need to cover here, or is this pretty much the high points?
Man, we've definitely touched all the high points. I'm just trying to think. I mean, I've probably fielded 300 plus questions of this in the last 24 hours. They've all been pretty specific to the person's scenario, but the answers have generally fallen into the stuff that we've covered here.
Yeah, I think we pretty much have it. And, obviously if you have a, professional that you work with, utilize them. If you want to look up John Briggs, what's the name of your firm again, John?
Incite Tax, and that's incite, like to incite a riot.
INCITE.
Yeah.
Incite Tax in Salt Lake City area. So, I think he's pretty busy, but maybe you're taking on new clients. I don't know. So anyway, either way, John, I certainly appreciate you coming and sharing with us. And, we're hoping, again, on an ongoing basis with Crisis Investing 2020, I really hope that we are delivering value here, things that are going to help you through this process and time. And all I can say is we really are in it together. So thanks for watching. That's it for episode 5. Great to be with you, and we are not even close to done yet. Episode 6 is going to be coming up, and in that episode we have Kyle Dennis. So we had a lot of wisdom, a lot of the gray-haired people, if you will, that have lived through many downturns in the economy sharing their wisdom. Kyle is a little bit of a different animal. He's a younger guy. He's in his 20s, has a very successful trading career. Can't wipe the smile off his face. He's got very positive energy. He shares what he's thinking about and what he's doing right now and how he's trading this market. And it's very stimulating to listen to him and see someone who's got this kind of youthful approach to this as compared to maybe some of the more seasoned people. All of them have great perspectives. This is something that's just a little bit different in energy and tone. And then also we have Ron Phillips. And real estate right now is something to think about. People have been asking, what do you think is going to happen in the real estate market? Is it going to crash? Is it going to go down a lot? What kind of real estate should I be thinking about buying? Is there opportunity here? Well, the guy that we want to talk to about that is Ron Phillips. He's our go-to expert on that, and he's going to share his insights and opinions about what's going on in the marketplace right now, what's going on in the economy, and how he sees it. And I learned a lot from listening to him. So that's it for episode 5, and I look forward to sharing all this great information with you in episode 6.
Our economy hasn't really performed poorly other than what's going on because we've legitimately had to shut down businesses. If we open everything back up, people get back to work. I think more downsides probably coming, but it's going to lead, in my opinion, to one of the best buying opportunities of at least my lifetime.
And yet here we are. A virus out of Wuhan, China has you and I talking today about a crisis that has crippled our nation for the better part of at least 2 weeks now. There's this, do I park money and wait, or do I continue to invest? And my suggestion is that if you invest with good fundamentals, it doesn't really make any difference when you're investing. Sometimes when you swing, you're going to hit a single, and sometimes when you swing, it's going to be a double, and sometimes you're going to hit a grand slam home run. The idea is that you get on base.